Okay, let's tackle one of the biggest financial questions you'll probably ever face. Should you pay a total stranger to manage your hard-earned money, or should you just go it alone? If you get it right, it could mean a comfortable, secure retirement. But if you get it wrong, well, that's what we're here to break down today. So, to really get a handle on what's at stake here, I want to start with a number. And trust me, it's a number so big it should make anyone with a savings account just stop and think for a minute. $280,000. That's roughly what a typical couple might end up paying a financial advisor in fees over their lifetime. Just think about that. That's over $250,000 that could have been growing and compounding in your account, not theirs. It's a truly staggering figure, and believe it or not, that's often just the starting point. So you're probably wondering, how on earth does it get that high? Well, that huge number, it's really just the tip of the iceberg. The real cost is usually buried in the details. The parts they don't always put in big, bold letters on the brochure. See, it all starts with something that sounds so small, so innocent, a 1% fee, 1% of your assets. It sounds harmless enough, right? Just one little penny for every dollar they manage. But the incredible power of compounding, it works both ways. Over decades, that small fee acts like a giant anchor, creating a massive drag on your returns. And this is where it gets really interesting because the cost just keeps stacking up. That 1% advisor fee is just the beginning. Your advisor might put you into investment funds that have their own higher fees, their own expense ratios. Let's say that adds another 0.7%. Then, if they're not careful with their trading, they can create unnecessary taxes for you to pay. You can tack on another 0.5% for that. All of a sudden, that simple 1% fee has actually ballooned to over 2% every single year. All right, so if you're paying that much, the big question is, what are you actually buying? What's the service? It turns out advisors sell a whole bundle of services and, well, they have wildly different values. Some are worth a lot, others not so much. And this right here, this leads us to the central paradox of the whole financial advice industry. The service most people think they're buying, some Wall Street genius who can pick the next winning stock, is statistically the least valuable thing an advisor actually does. The data is crystal clear. The vast majority of active fund managers fail to beat simple, low-cost index funds. The real high-impact value is something much more human. It's behavioral coaching. A great advisor earns their fee by essentially being your financial bodyguard. Their most important job is to stop you from making catastrophic emotional mistakes, like selling everything in a panic when the market crashes. They can also add huge value with sophisticated tax strategies and by coordinating all the different pieces of your financial life. But honestly, maybe the most valuable thing they do is just give you back your time and your mental energy so you can focus on your career, your family, or whatever you do best. So this all leads to the obvious alternative, right? If a simple index fund portfolio beats most of the pros anyway, why not just do it yourself and save all those fees? And you know what? The actual strategy for doing it yourself it's shockingly simple. This 3-fund portfolio gives you amazing global diversification for a tiny, tiny fraction of what an advisor would cost. It's a strategy that's been praised by investing legends. So, problem solved, right? We just do this and save a fortune? Well, here's the catch. The strategy itself is simple, but actually executing it, sticking to it, that's a whole different story. The do-it-yourself plan has one single critical point of failure, and it's us. Study after study shows that the average investor is their own worst enemy. We get greedy when the market is hot and we panic sell when it's crashing. We consistently underperform the very funds we're invested in, all because we let our emotions get the best of us. I mean, let's be honest with ourselves. It's easy to say you'll buy and hold when the market's soaring. But can you really watch your retirement savings drop by 40% and not hit the sell button? That's behavioral risk. Then there's what I call complexity creep. Life happens. You get married, you have kids, you start a business, and suddenly your finances aren't so simple anymore. And maybe the scariest risk of all, the unknown unknowns. Those are the costly mistakes you're making simply because you don't even know you're making them. Okay, so how do you decide? How do you figure this out for yourself? Let's try to build a simple framework to help you find the right answer for your specific situation. Here's the key insight. An advisor's value is not a one-size-fits-all thing. It's a sliding scale. It changes, and it scales directly with how complex your financial life is. If you're young, just starting out with a simple 401k, the value is probably pretty low. But if you're a business owner approaching retirement with multiple accounts and complicated taxes, the value can be absolutely immense. And what that means is that the question we started this whole thing with, is an advisor worth it? It's actually the wrong question. It's too generic. To get the right answer for you personally, you have to start asking better, more specific questions. So forget the generic debate. Instead, ask yourself these things. First, what specific problems do I need an expert to solve for me? Is it complex tax planning? Is it estate coordination? Next, can I actually put a dollar value on what they're providing? Can I quantify it? And finally, this is the big one. You got to be honest with yourself. Am I truly emotionally disciplined enough to do this myself when things get scary? And how much is my time really worth? Now, if you do decide that hiring a pro is the right move, there is one term you absolutely have to know, and that term is fee only. It means they are paid only by you, the client. They don't get kickbacks or commissions for selling you certain products. This is so important because it removes that massive conflict of interest and helps ensure their advice is aligned with your best interests, not someone else's. You know, when you strip it all away, it really just boils down to this simple truth. The right advisor is an investment in your future. They save you from making errors that could cost you far more than their fee. But the wrong advisor, well, the wrong advisor is just another one of those costly mistakes. So forget all the noise about beating the market. The only question that really matters is this one. Is your advisor saving you more than they cost you? Can you point to specific ways they are adding more value than the fees they charge? Your entire financial future could depend on how you answer that question.